Welcome to the Nichols Tax Update Podcast, issue 2136. This is a standard disclaimer. I invite you to read it. I do, however, want to acknowledge the value in my preparation of this program of my subscription to Tax Notes Today. Published by tax analysts, it is, in my opinion, the preeminent source of information for tax professionals. What do we have to work on this week? 6 items that attracted my attention I thought you might be interested in. Interest rates for Code Section 2032A Special Use Valuation of Farms have been published, and of course they're different based on the area of the country or the state in which you live. Guidance for IRS employees on how to handle a request to revoke a Section 754 election. There are so many requests now that we have a form for it. A nonprofit corporation has lost its federal 501c3 status. Why? Because it failed the operational test. More about that shortly. And as CPA attorneys' willfulness penalty troubles continue with the question of specific intent and whether specific intent is necessary to find willfulness under the statute. Next to last this week, changes made by the Tax Cuts and Jobs Act to the general principles of foreign tax credit for corporations are the subject of an IRS practice unit training their employees, but I thought I would share just the essence of the change with you this week. Finally, an actress's expenses are deductible. Why? Because she kept really good records. Let's start with Revenue Ruling 2021-15, the special rules that apply to value of family farms for estate tax purposes. The interest rate used when an election is made to use the special valuation method changes with market conditions that are published periodically by the IRS. In this revenue ruling, the IRS announces the interest rate for applicable elections, setting a rate for valuing estates arising after 2020. The revenue ruling contains a list of the average annual interest rates and the locales to which they apply. Let's take a look at that. This is the essence of Revenue Ruling 2021-15. The location of property can be in one of 4 different farm credit banks: AgFirst, AgriBank, CoBank, and Texas. The rate of interest used to calculate the present value for estate tax purposes of your family farm based on the income produced or the fair market value as a farm is calculated using the discount rate or interest rate that's shown on the right-hand side of your screen. Unless you have a farm practice, you probably don't care much about this, but if you do, and you're in South Carolina, you need to know that you're going to use an interest rate of 5.25%, a discount rate, 5.25%, to calculate the fair market value of a family farm in an estate arising after 2020. Next, this about revoking the Section 754 election. What is that about anyway? Well, since time out of mind, which is an idiom that's lost in history, it means a long time, beyond when anybody can remember, partnerships have made a Section 754 election to revalue the portion of partnership property represented by a partnership interest transferred in a taxable transaction, including the death of a partner. The election was beneficial when partnership assets had appreciated, and it recognized that the acquiring partner could report and pay tax on her or his share of partnership income, allowing depreciation or amortization to be separately reported on the portion of partnership assets attributable to the partnership share. The Bipartisan Budget Act of 2015 changed partnership income reporting, and income tax liability is now an issue for the entity, not the partners. So the Section 754 election became a burden, and the IRS has been besieged by requests to terminate the election. Not because it would cause a reduction in the depreciable value of partnership property, because you can't terminate the election on that basis, but because it simply was an administrative pain in the butt. So the newly published Form 15254, don't worry, I have a sample of it for you, instructs partnerships to file requests to revoke the their Section 754 election with the Ogden, Utah Service Center. You have to provide all the information relating to the reasons for the revocation request and a statement that this will not result in a reduction in the basis of partnership property under either of the revaluation statutes, 734B or 743B. Revocation of the election will not be accepted if the purpose is to reduce an income tax liability. My response to that is, okay, go figure. Here's the form, 15254. The name of the partnership, the employee of the if you're enclosing a power of attorney, and if the form 2848 is in this package, see the instructions for when it's required. Caution, in order to prevent delays in processing the request. Well, there are delays right now anyway, no matter what, because the IRS is so far behind. Part 1, information for all requests. Has the partnership previously revoked the Section 754 election? Well, I ran out of space, and so I had to use the next slide, but I overlapped a little. Here's Part 1. Has the partnership previously revoked? No, we haven't. Does the Section 754 election result in or expected to result in a substantial administrative burden? Yes. Has the nature of the partnership business changed? No. Has there been a substantial increase in the assets of the partnership or a change in the character of the partnership assets? Maybe yes, maybe no. Has there been, is there expected to be, an increased frequency of retirements or shifts of partnership interest? Yes. Yeah, we don't have to go through this 754 election all the time. Will the revocation result in the avoidance of a reduction in the basis? The answer to that has to be no, or you won't get your revocation approved. Next, 501c3 status of an organization is revoked. Revoked is a scary word over there, and it should be. The organization was granted 501c3 status based on statements it made in its organizing documents. It was incidentally going to rent water sports equipment to raise money, and it was going to do all kinds of environmental studies and going to hold classes. Well, it rented a lot of water sports equipment and it made a lot of money, but it didn't hold very much environmental protection activities, didn't hold many classes. So those activities wound up being insubstantial, while a substantial part of its activity was renting water sports equipment. It failed the operational test. 501c3 status requires the organization to continue to pass both tests all the time. The organization must also be careful to avoid allowing a non-exempt purpose to become substantial in relation to all of its goals and activities. So you organize to do this or do that, you should be sure to do this or that. Willful disregard of the law. John Q. Rogers, an attorney and a CPA, is in all kinds of trouble out of the Ninth Circuit. He's dealing with the penalty for willfulness, and he cannot escape the negligence penalty because the IRS said he willfully, which is what negligence is. If you look at Section 6662B1, negligence is pretty much all-encompassing. And he's looking for relief under Section 6694, which you can get relief, but you can't get relief from willfulness. So Attorney Rogers has argued all kinds of, he's been up and back with the district court a couple of times. So the Ninth Circuit Court of Appeals finally sent this back a second time, directing the district court to determine whether a CPA Attorney Rogers acted with specific intent, and the lawyers are defining specific intent, to understate his reported tax liabilities as required for finding of willfulness. The Ninth Circuit infers that if Attorney Rogers did not have specific intent to help a client avoid his tax liabilities, that you could not find Attorney Rogers to be willful, and therefore you would have to grant him relief under Section 6694. This goes a little beyond how many angels could dance on the head of a pin. I think it's important for all of us. We prepare tax returns for others. We give tax advice. We write tax opinions. We must be diligent. You cannot look the other way. You cannot pretend the law is something other than it is, and you cannot pretend that your client's activities are something other than they are, and you cannot ignore what is obvious about the client's operations or the client's lifestyle or the client's business methods, and look the other way and just put the numbers in the little boxes. Well, you can do it until you get caught. But then there's John Q. Rogers out there in California. He got caught. The Tax Cuts and Jobs Act changed the federal tax credit principles. Foreign trade is another word for tax complexity. You're going to pay taxes in the foreign jurisdiction. You're going to pay taxes in the United States. In order for a foreign tax to qualify for the federal tax credit, the following 4 general criteria must be met. The tax must be the legal and actual foreign tax liability. The tax must be an income tax or a tax in lieu of an income tax. The tax must be imposed on the taxpayer. And finally, the taxpayer must have paid or accrued the tax. The Tax Cuts and Jobs Act changed the law to require calculation of the foreign tax credit separately for a corporation based on the type of income subject to the foreign income tax. For corporations, subsequent to the Tax Cuts and Jobs Act, there are 6 separate categories of income for which a separate foreign tax credit limitation must be calculated. This applies to taxable years beginning after 12/31/2017. Global intangible low-taxed income, foreign branch income, passive income, income from certain sanctioned countries, certain income resourced by tax treaty, and a general category income. 6 baskets. And you calculate the foreign tax credit separately for each basket if you're preparing a corporate income tax return intending to claim the foreign tax credit. Finally, this month or this week, it seems like a month, expenses are deductible based on her excellent records. Gail Gaston, the mother of a successful actress, spent time and money promoting her own career. She, however, was not successful. At least she wasn't successful in the years under audit. And by the way, that is Lily Langtry over there on the right. That is the famous Lily Langtry in costume as Cleopatra. She was more successful than Gail Gaston. She did, well, Gail Gaston, did everything reasonable to promote her work as an actress. However, she hired an agent, went to auditions, stayed visible in Hollywood, kept meticulous records. Even though she didn't make a profit, the court said it's obvious that she intended to make a profit. All of her actions are those of someone who is engaged in a trade or business, and you don't have to make a profit to deduct your expenses, but you have to sure put on a good show. You have to look like you're trying to make a profit. And I think Gail Gaston was really trying to make a profit. But I have a question for you. Do you suppose it helped that she had been successful as a Mary Kay National Sales Director? What I read about the IRS evaluating my deducting expenses where I'm deducting expenses and I don't earn any money this year or next year, do I have a history of success in business so that I have a reasonable expectation of success when I spend this money? That's why Gail Gaston's meticulous records were viewed in a favorable light. Well, gang, that's it for another week. I thank you. I appreciate your company every week. I look forward to working together. Stay safe. We need everyone. We're going to get through this.